This robust inflow from the mutual fund industry in the month of October, and that to a certain extent is very contrary to what the market was estimating. How have you read into the overall numbers?
I think market was expecting robust inflow to mutual fund. This trend was visible over weekly inflows, and I did mention in one of your show that October inflows will be higher than September as well as August. This is a function of couple of things. One, obviously it is maturity of investors. They are buying more when there is a correction. Second, it is hard work of distributors who have been hand-holding their customers, and despite negative return over last 12 months in equity funds or in SIP, they are requesting people to take a longer-term view. So one, maturity of investors, and second, hard work of distributors is resulting into a scenario where mutual fund flows have remained robust.
Right, Nilesh, the liquid category as well saw an inflow this time around compared to an outflow of more than 2 lakh crores in September. Is there a change in perception soon, and will you see the money returning into the system?
So when we are looking at September outflow, we must also take into account August inflow. So if we take August inflow of more than 1,70,000 crore and September outflow of 2,20,000 crore plus, then it does get normalized. Typically, September is the month when there is advanced tax outflow, and this time there was FX intervention, which made systematic liquidity tight. In the month of October, despite currency in circulation going up, the sanity has returned and inflows into liquid funds have increased. So we believe money markets are now settling down, and the scare which was created by IL&FS default is now behind us. Many of the NBFCs have started resuming borrowing, and many have tightened their asset liability matching. So effectively, there is a normalcy returning to liquid and money markets.
Right. Nilesh, income funds have seen consistent outflows. Do you think there is more worry for the dent in the market going ahead on account of that?
Income fund outflows are more related to credit scare created by IL&FS default. There were many credit funds where there were exposures to IL&FS and some of the other NBFCs where people have doubt on their credibility. So this outflow is in relation to credit scare created by IL&FS. But if we now look at one, the coupon income on credit risk fund is almost into double digit for most of the funds. And by and large, structuring has been reasonably good, which ensures that mutual funds should be in a position to recover their money. Combination of this higher coupon and good structuring will resume retail investors' interest into credit risk fund. So my feeling is that not necessarily in November, but somewhere towards beginning of next year, bond fund inflows will start turning positive.
Okay. What trend do you foresee for the SIP book, given we have seen limited incremental money come in via that route?
On the SIP side, clearly there has been some closure. Not necessarily all investors are matured. Not necessarily all investors can be covered by distribution network. Not necessarily all investors will listen to sage advice from distributors or from media. So there will be some amount of closure of SIPs, but clearly the good point is that the new SIP creations is far more than the closure of SIPs. We believe SIP is the right way of making investment. It allows people to average into a rising market, falling market, and that's the best way to optimize your entry point. So we are going all out to pursue our investors, to support our distributors, to continue this SIP culture. Globally in US, where mutual fund assets are bigger than banking assets, a great extent this is possible due to 401k kind of plans, which is nothing but SIP. We would love to create similar kind of culture in India where every Indian has an SIP.
And what would your excuse me, what would your message be for retail investors? For someone who are really feeling that they've missed the bus and they focus too much on noise rather than long-term portfolio planning.
There's no better day to invest when you have money, and the key to success continues to remain 3 time-tested principles. 1, regular investment. SIP will be a best way to invest. Second, long-term investment. You really can't have shortcut to success. And third, a disciplined asset allocation. Please keep balance between debt, equity, commodity, currency, and real estate. Don't just, get overweight on one asset class in particular. Combination of these 3 will ensure that you have enough money, what you need.